Hello and welcome to Kaplan Professional Education's June PDsessions. Coming up in the program, regulation of margin lending in Australia.
Essentially what most of them are heading towards was stress scenarios into the client's circumstances. So what I mean by that is actually then testing their ability to meet interest cost using a high interest rate that actually applies at the current time.
Using a client value proposition to better handle client fee objections.
I think it would be really helpful if advisors embrace the fact that value is something that's not actually specified, it's perceived. And it comes from an awareness on the part of the client, and the awareness comes from the client having a quality experience rather than simply having a transaction completed.
Demystifying derivatives for clients.
Essentially, a derivative is anything that derives its value from an underlying security. So that could be a CFD, for example, an options, a warrant, a futures contract. So there's a couple of different derivatives available to investors.
The path and growth of Islamic finance in Australia.
I believe the industry probably manages about 170, 180 million in funds at the moment. What makes Islamic finance an easier one to tackle in Australia is superannuation, because you have a captive market to target.
Hello, I'm Ron Wilson. In this month's news, the May 3 federal budget saw a raft of proposed taxation and superannuation changes announced, which, if legislated, are likely to have significant implications for financial advisors and credit representatives. The budget also featured a number of business tax relief measures as part of a 10-year enterprise tax plan for small businesses. On the inflation front, the RBA responded to deflationary fears arising from a drop in March quarter inflation by dropping the official cash rate to a new record low. Michael Pollock has the details.
The federal budget, delivered by Treasurer Scott Morrison on May 3, proposed a number of significant taxation and superannuation changes. The major changes can be summarised under three broad headings: personal income tax relief, 10-year enterprise tax plan for small to medium business, and superannuation reforms. From 1 July 2016, the personal income threshold for the 32.5% tax bracket will be increased from $80,000 to $87,000 to limit the impact of recent bracket creep. For individuals with incomes over $180,000 per annum, the current 2% temporary budget repair levy will not be extended beyond 30 June 2017. A new low-income superannuation tax offset, or LISTO, is proposed from 1 July 2017 to reduce tax on superannuation contributions for low-income earners. This offset will be capped at $500 and apply to members with adjustable taxable income of up to $37,000 per annum. From 1 July 2016, the company tax rate will be cut from 28.5% to 27.5% for small business, and the annual aggregated turnover threshold will increase from $2 million to $10 million. This threshold will be progressively increased each year until 2022-23, when companies with a turnover under $1 billion will have access to the reduced company tax rate. From 1 July 2016, the unincorporated small business tax discount for individuals receiving business income outside of a company structure will increase from 5% to 8%. Businesses must have turnover of less than $5 million to be eligible. Turning to superannuation reforms, a lifetime non-concessional contributions cap of $500,000 indexed to ordinary time earnings was introduced and effective from budget night, May 3, 2016. This cap is retrospective, taking into account all non-concessional contributions back to 1 July 2007. The lifetime NCC limit will replace the existing $180,000 annual cap, an operation of the Bring Forward rule. From 1 July 2017, the annual concessional contributions cap will be reduced from $30,000 to $25,000 for all taxpayers regardless of age. Other proposals which would take effect from this date include the removal of the work test regulations that currently restrict people aged between 65 and 75 from making superannuation contributions. Individuals up to age 75 will be able to claim a tax deduction for personal contributions regardless of employment status. This effectively removes the 10% rule, which prevents many self-employed people and partially employed people from claiming a deduction for personal contributions. The government also proposes to introduce from 1 July 2017 a $1.6 million cap on the total amount of superannuation that can be transferred into a tax-free retirement account. The US economy expanded at an annualised rate of 0.5% in the first 3 months of 2016, according to the advance estimate of GDP released by the Bureau of Economic Analysis. This was much lower than the 1.4% expansion in the fourth quarter of 2015. The first quarter increase in real US GDP was more than accounted for by an increase in consumer spending on household services, notably housing, utilities and healthcare. However, consumer spending on durable goods declined. Overall, the weaker US GDP growth indicated that American consumers had controlled their spending. Demand also slowed in the first quarter. Australia's inflation rate fell 0.2% in the March quarter, bringing the annual rate down to 1.3%. Well below the RBA's 2 to 3% target. Quarter on quarter, consumer prices dropped unexpectedly by 0.2% following a 0.4% increase in the December quarter. The negative quarterly number was the first since the fourth quarter of 2008, while the 1.3% year-on-year annual growth is the lowest since the September quarter of 2009. This led to the RBA cutting its official cash rate by 25 basis points to a new record low of 1.75% at its May meeting to head off fears over deflation. The government has announced a $127.2 million reform package to strengthen ASIC's operational abilities in response to a review of the regulator's capabilities commissioned during 2015. The components of the funding package are $61 million to improve ASIC's data and surveillance facilities and modernise its data management systems, $9.2 million for ASIC and the Treasury to implement appropriate law and regulatory reform, and $57 million to enhance specific surveillance of the financial advice, responsible lending and life insurance industries. The government has released a Progressing Professional Standards Reform Statement in which it announced some amendments to the draft legislation covering the professional standards for financial advisors. The new proposal sees an extension in the amount of time that existing advisors will have to reach degree equivalent status and to pass the new exam requirement. This can be achieved via a number of flexible pathways, including completing bridging courses approved by a new standards body. The timeframe to meet the advisor education and exam requirements has been revised from 1 July 2017 to 1 January 2019, while existing advisors will have until 1 January 2024 to reach degree equivalent status and until 1 January 2021 to pass the exam.